Good morning, good afternoon, good evening, and welcome to the Thursday, the 3rd of November, Bull versus Bear webinar. Steve Miley on the call for Trade Day. Welcome, everyone. We're going to go for a usual regular run through calendar, what we've had, what we've got coming up, macroeconomic fundamental articles from the major news wires, plus the charts. So morning, Clinton. Can you talk about the critical line of support of 37.57 from the TA report and why it's so critical? It seems like a very, very interesting AM with us breaking down below right now. Yeah, it's a critical impulse point from last week. We went right down to on both the S&P and the NASDAQ to some very important levels from last week. I think it was the impulse point from last Friday or maybe before that. We'll take a look shortly. But we went right down to them post-the Fed sell-off and sort of held right at them. The market clearly ran out of time, didn't want to take them out. And then but on the overnight, as you say, we're starting to nudge down through them. So, and the NASDAQ took it out last night, I think, and the S&P this morning. So having had a little bit of a bounce earlier on, when I got up in the beginning of European day, futures had bounced slightly. I mean, not much, 1/4%, 1/3%, something like that. But now we're obviously giving all that up and lower again. So we're taking out those supports. So it's kind of, as clinging on to like a positivity, thinking, no, the market's down, sitting at support. Didn't take out that big support yesterday. Big event though, but very, very bearish, obviously. But then whilst holding a big support, you've got to say, right, okay, there's a good chance now we're going to bounce from there. But now we're taking it out. It's more concerned that we're going to just go straight south, straight lower. But we'll come to that when we come to the charts. So let's kind of go backwards before we go forwards. Initially stocks and risky assets spiked up higher after the hike and the statement, because the statement effectively opened the door to a smaller rate hike at the next meeting, saying that, they're going to step back from that. That's what we got from the statement. And the market's like that. We said before the calendar, the Fed Watch tool in here now for December, you can see it's still pretty much pricing in where we were. It's been about 50-50 between the 50 and the 75, the whole time. At some point, it's been a little bit higher in here, but we're now looking for, around 50-50 in here, between 50 and 75 at the next meeting. So no real change here. It's the concern is further out. If we go out to the May meeting now, you can see more likely peaking now at 525, 550. So the peaking rates now, 525, 550. Previously, it had been as low as 475, 500, and mostly it's been at 500, 525. So we've got a higher peaking rates. Okay. And then also, that was from the statement. So, sorry, not from the statement. The statement kind of gave us, okay, looks like we're going to back off on how aggressive we're being. But then Powell came out and said, he effectively said that we're going to do what we need to do. The market shouldn't be he's thinking we're going to be slowing down anytime soon. And he also, blatantly said that the peaking rate's going to be higher than you guys are expecting. So that we're going to go further in rates. And the market started to price that in already. That was the big kind of takeaway. So that's definitely, even though the next hike, is now looking for a less aggressive than we've been having, the 75 is going to a 50. The forward guidance is that we're going to go higher as we go. So that's obviously a negative. Higher rates are negative for stocks, and obviously the Fed are more concerned about a recession. So we saw a significant sell-off, and more concerned about inflationary pressures. And so we saw a significant sell-off, but we were holding right at those supports, and we'll talk about those supports. And so it's difficult to sell into a big support, but now the market's breaking through those supports, that opens the door to lower. So let's have a look. 5 things you need to start your day. So obviously looking at the Fed, first of all, Chairman Joe Powell had little doubt that he's prepared to push rates as high as needed to stamp out inflation. Raised by 75, we know that. Interest will go high in the year. Powell said, but also signaling the path may soon involve smaller hikes. But then, indicated that it's going to be at a higher level. Sweeping changes from Musk, looking to do big job cuts, nothing really impacting us there. Committed to zero. China's top level said the nation's zero tolerance approach remains the overall strategy. So there were some glimmers of hope that a 2-day rally, be it on reopening hopes, they've been dashed. Okay, risk off. And so Powell, certainly. We had the initial risk on move, and then we went to risk off. And then talking here about the pound dropping again this morning. We've got Bank of England coming up in 25 minutes, pretty much as we come off this call. That's going to be important. So watching out for that. That's 8 a.m. Eastern. So that's in about 30 minutes time. We get the Bank of England. So going back to the calendar. And also this morning, we had service sector and composite PMI actually beating expectations in here from the UK. So showing that a still strong economy, so scope to be more aggressive. And we are looking for a big rate hike of 75 basis points. Here we have Bank of England currently at 225, looking to go to 3%. So that's coming up in about 25 minutes. And then 30 minutes after that, in 55 minutes, Bank of England Governor Bailey will be speaking. Going on for the US, we get jobless claims also in 55 minutes. And then the focus is going to switch to, first of all, the S&P Global PMI, both the service and composite data. That comes at 9:45 Eastern. And then the ISM data, which is the more important PMI data, that's coming out, the non-manufacturing / service sector data coming out at 10 o'clock Eastern. Okay, so we're watching for that going into this afternoon. Okay, did Powell contradict the statement by saying or was the statement misinterpreted? No, he didn't contradict. So basically, he effectively initially said, initially in the statement, the statement said we're going to go more gradually. So there's a difference between the peak and gradual, right? So yes, they're going to slow down, but they're potentially going to go higher, right? So that's what he said. He didn't contradict it. He basically said they'll do what they need to do. They said in the statement that the pace is going to slow potentially, but the end point is going to be potentially higher. Okay, does that make sense? So it's effectively going further, but at a slower pace. So they don't really contradict each other, Clinton, is the answer to that question. Okay, but overall for the market, it means that, higher rates, a higher peak is worse, right? It kind of doesn't matter how quickly you get there, it's where they're going to. Right, so that was the bigger concern and why we saw the aggressive sell-off. Okay, we've run through the data. Let's go through. We looked at 5 things. So sell-off deepens as Bank of England in focus after Fed warning. Looking for higher Fed funds. It says there, look, so investors believe a higher peak in Fed funds next year. And stocks, bonds, all falling, dollar gains. Okay, so no surprise to dollar gains on a more aggressive Fed. Pound under fire, risk of smaller than expected Bank of England rate hike haunts markets. Flag risk of a smaller than expected hike. So we are looking for, and even though normally a smaller hike in here is certainly being seen as a negative because we need to get hold of control. So we need to get control of inflation. So the expectation is for 75. If they only deliver 50, that will not be good for the pound. You can see expect a big sell-off in the pound, probably a significant sell-off, I should imagine, in UK stocks as well. Deeper US recession looms as resilient labour market spurs Fed. Yeah, so the labour market is staying strong, as we spoke about that. Unemployment, they need to hit 6% for inflation to drop to 2% in here, has been said. So the odds of the US recession are rising. And the chance it will be mild are falling. Okay, so what else do we have? Powell sees higher peak for rates, path to slow tempo of rate hikes. So that's what it's saying there, Clinton, okay? Ongoing increases until rates are sufficiently restrictive. And that's going to be at a higher point, they told us yesterday. What else do we have? Bank of England set to deliver biggest rate rise in 33 years. Let's see if they do. So we've got that in now just over 20 minutes. European stocks down, Powell crushed pivot hopes, pre-Bank of England, all the same stuff. Futures signal more losses on Fed's rate hike view, so we're down again. This morning, FTSE 100 drops ahead of massive BOE hike, hit by Fed nerves, all the same stuff in here. Shares fall as Fed not close to done. Bank of England next. And UK service slump, we've already looked at the PMI data, slump at fastest pace, but they did actually beat expectations on the service sector in here. Let's take a look at what we've got in here. So European exchanges this morning. What are these two here? What have I got open up here? Oh, I don't know why those have popped up. So European bourses this morning. Sorry, one sec. So it's not opening up, but we're down, FTSE, DAX, CAC, the major European stock indices, down between 0.75% and 1%. Remember, they're playing a bit of catch up though this morning because they closed before the US closed and we sold off right into the bell. And if we go and take a look at, again, this isn't opened up. So we were down 1.5% on the Dow, over 2% on the S&P, over 3% on the Nasdaq yesterday, and we're lower again this morning. Nasdaq's down another percent in here this morning. S&P 7/10. Okay, let's take a look at the. Just bear with me a sec. Just need to do not disturb me. I keep getting pop-ups. Oh, it is on. Okay, so let's take a look at the charts. Sorry, in here, guys. So I'm going to kick off with the S&P. So there's that impulse point. That was that impulse low. So the rally came from Friday, but the impulse swing low in here that I flagged, 37, 57 and a half. Okay, so the market held there last night. We kind of bounced from there this morning and then down through there this morning. So that completes a better top. It's a really important, it's a swing low on this whole rally. Okay. It was the most prominent swing low we've taken out. So the fact that we held there, I didn't want to turn bearish before we took that out, Clinton. And now we've taken that out this morning. Now it has taken it out, obviously, in pre-market hours, in European hours. So there is liquidity now. It's taken it out. There's liquidity. You guys are up. Trading desks are up in the US, right? So the US is awake and up and running. So it is taking it out. Volumes are increasing. So I think it is relevant, but you'd want to see it stay below there. You got this next support in here. It takes this next one out at 36.5. That would look really negative. And if we go to the 15 minutes, so I was clinging on to, so there's the low from yesterday. We're just holding above the low, here from yesterday, just holding above it. And then we get the rebound overnight and then boom, down through it this morning, more recently. So certainly setting up a lot more negative. I think cash market open is going to be important. Do you see buyers come in? I don't think so. I don't think the buyers come in. I think we see us go lower again in here this morning. I think we're going to get us heading to the hills. And again, it was similar to the Nasdaq. Look, there's the swing low there. The swing low on the Nasdaq was at 921.5. Kind of held right down there last night. Got right down to it in here last night. And then you take it out, just after the bell, and then kind of hovering around it, rebounded from it, and then significantly down through for the Nasdaq. And it's looking really weak going into this morning. I mean, I think, you can put the counter, we've got these little counter trend lines. I would advocate putting these on, these little counter trend lines from the overnight activity. If you can get back above those, then it's going to signal reversal. That's what I would be looking at on both the S&P and the on the Nasdaq, these little counter trend lines from the overnight activity, and see if the market can get back above these. But if we can't get above those after the opening bell, boom, I think all the risk is further south. We could have another 1 to 2% down day on these major averages quite easily today. Okay, so just bearish on those now, having taken out those supports overnight. Let's take a look at gold and oil. Oil actually holding in better, despite this, the risk off move. We did make a new high yesterday, dip lower. It's dipping down this morning, but any kind of rebound in stocks could see, still kind of in this kind of range. And yeah, I'd be looking to buy this on the next swing. Okay, so I think this, you got this counter trend line going across there. You got the more aggressive one coming down from the overnight activity. Back up through there, it's very resilient oil, So any kind of pop up in equities is probably going to see oil fly. So you've got the trend lines coming in around 88.80, and then this little swing peak is at 88.93. So up through 88.80, 89.00 would see a more bullish tone on oil. It only gets more negative below these lows here, below like 87.75 to 87.55 area. Only down through there completes a top, and it looks more negative. Let's take a look at gold. So very negative on gold. Big failure session. I was hanging on to a more bullish tone into yesterday on the close because we were holding again these below the lows from the previous day. But we've wiped out the lows from the previous day and now down right on this low in here, this swing low from last week, from the beginning of last week, although actually maybe the week before. Yeah, no, from the week before, from the Friday before, which took out this low here. So we're back on the lows. So we were holding in yesterday. If I go to the 15-minute on gold, so we sold off. We're holding in above this low. We held there, bounced, and then plunged through this morning. And now you've got the target in, we're down at the lows from over here. And actually down through those lows, I think. sitting right. Actually, no, we're piercing down through those lows. So we're making new lows. So gold looks very negative, even more negative than the stocks. So yeah, short of gold. If you want to buy something, oil's the one that I would look be the only one I would venture, and even that's tentative. And the stocks look very negative, but watching out for what we do on the cash market open. Don't forget we've got the ISM data as well, and don't forget the Bank of England in just now 14 minutes. The Bank of England can have an impact depending if they're as hawkish as expected, 75, or if they're not as hawkish, that could have an impact. I think if they're less hawkish, if they only go 50, the market's going to hate that, and we'll see stocks lower on because they're being less aggressive in their fight with inflation. So we need to keep an eye on Bank of England as well. That's in 14 minutes. And then you've got the rest of the data coming through. Jobless claims, cash market open, and the two PMI datas from S&P Global, and then more importantly, ISM. All right, guys, a bit of a quick one today. I'm going to wrap it up there, though. I'm going to wish you all a great trading day. Stay safe. See you soon.